Hey everyone, welcome back to the channel. This is Ben Morales, your personal financial coach, and I'm happy to be with you once again today. And today's video is going to be really answering a question that I got recently. A client asked me, why is having cash flow so important? And why is it so important to focus on cash flow over an interest rate? And I thought it was a great question. I was really compelled by it. And so I wanted to make this video to give a simple explanation, trying to really explain the simplicity of cash flow and why it is so important. But first, I want to just talk about what a mortgage is, because in that conversation, we were actually talking about mortgage, right? So when we go to a mortgage, the bank is going to offer us a loan program. Most of the time is going to be based on rate, because most buyers, what they want to do is save money, and they want to save money based on the rate. And so I wanted to say, mortgage, what is it? It's a loan on a piece of property that the borrower promises to pay back to the lender with interest. Now, if you don't know this, or if you've never taken the time to really find out or dig into deep of the meaning of the word mortgage, mortgage actually means mor is a Latin for morir, muerte, right? So it's actually a death, and then engage means pledge. So it's actually a death pledge. Well, if it is a death pledge, what are we pledging debt to? Well, what we're pledging debt to is cash flow, because inside of a mortgage, there is zero cash flow. Any cash flow that you have extra at the end of the month that you were to send into a mortgage to drop down their payment, that money, you will never see it again. That money is gone. If, in fact, if you wanted access to that money, you have to go back to the bank and ask them for that money back in the form of a refinance, right? So that's just ridiculous. You're paying them the money, it goes to them, they invest it, and now you got to go back to them and ask them to approve you so you can have it back again. The system is rigged. So how do we get out of that? Well, we got to use the right product, and that's what a home equity line of credit is. So another thing with mortgages, mortgage loans rather, is they're sold on a rate of interest. They want you to look at specifically on a rate of interest. They don't want you to really consider the long-term cost, right? So they never talk to you about the cost of the loan. But I encourage you, when you get a chance, look, if you bought a home recently, look at your closing statements, right? Your closing statement of what that loan is really costing you over time. Aside from the interest rate, you're going to be shocked by what you find out. So how can we compare what a line of credit is in comparison to a mortgage? So we need to change, right? We need to stop looking at only a mortgage rate. If we stay looking at a mortgage rate, we're going to miss it. And that's exactly what they want. And so what I wanted to do is give you an example of a day-to-day item that will illustrate how a home equity line of credit works and how it really improves your cash flow. So the item that we're going to use is something that I buy throughout the course of the month, and that's a box of juice. So let's say that in these expenses here, right, this client has these expenses, and part of the $5,189 of expenses on a monthly basis are juices. It's a box of juice, and that box of juice, right, throughout the course of the 30 days has to be purchased twice, because that box of juice only contains 20 juices, right? That box of juice is on sale at the grocery store. We're going to say that it's on sale for $4. But throughout the course of the month, I either have to make 2 purchases of that box of juices, or I have to return back to the store and buy another box of juice. So we're going to have to add another box of juice. So if we added it up, that will give us, throughout the course of the 30 days, $8. So part of our expenses is $8 that is going toward a box of juices throughout the course of the month. Now, what if one day going to the grocery store, and it's, again, I have to make these purchases anyhow, but I go to the grocery store one day and I discover that that day now they have a bigger box, and guess what? It's my favorite juices again, right? Same juices that I'm used to buying, but now it's a bigger box. That bigger box has a price tag of $7. So I don't know if I like that, right? It's cost more, but inside of that box of juice is actually 40 juices. So 40 juices. So this is how cash flow is similar in a line of credit. Although the line of credit here, right, we're going to say this is the line of credit. HELOC, home equity line of credit. This one here is a mortgage. This is what the bank tells us. This is what we're all used to because they sell it every day. It's advertised every day and so on and so forth. So much information is coming about mortgages. Very little is known or utilized about the home equity line of credit. So although it does have a higher price going in, what is the effect on the cash flow? Very simple. If we have to spend $8 to cover the 30 days because these juices are not enough, well, buying 40 juices and making one purchase here means that with the one purchase, our cash flow is covering not only for the month that we're buying the juices for, it's actually covering the next month, just like this one is. But at the end of that particular 30-day cycle, we have $1 left, right? Now, when it comes to big numbers and a mortgage versus a home equity line of credit, what will we do with that dollar that was left over? Well, we would take that dollar and we will come over here and we would apply it to the interest on the home equity line of credit. And what that would do is that would impact the amount of interest that is being paid on a daily basis on the home equity line of credit, which essentially speeds up the process by which we pay off our debt more quickly. So I hope this makes sense. It's a very easy concept when we look at it in everyday terms. All we're doing is utilizing the cash flow of money that we would have spent somewhere else, moving it over to making it more efficient, applying it right back to the interest, eliminating our debt as quickly and as possibly as we can. So for more information like this, please like, share, subscribe. Let me know in the comments what you thought about the example. And if there's anything else or any other example you would like to see, put that in the comments as well. Thank you for tuning in, and until the next video, take care and God bless.